advisors. And Mike is going to be providing some background on State Street and then specifically our investment solutions group. He might refer to them as the ISG team at State Street, but they manage our strategic ETF portfolios. We'll dive into their investment process and their methodology for constructing the strategic ETF models. Feel free to ask any questions along the way. As Andy mentioned, you can type those into the chat. We'll definitely leave some time for questions at the end. And with that, Mike, take us away.
Sure, thanks, Bobby. So we're going to break this presentation up into really three segments: a quick firm overview, an overview of the ISG team, that's the team that's managing the model portfolios, and then take a little bit of a deeper dive into the models themselves so you can see exactly what the makeup is of those models. So to begin with, State Street was originally founded in 1792, so we're well over a 200-year-old institution, and we're responsible for about 10% of the world's assets. That includes asset management. We have approximately $3 trillion in assets overall, 2,400 clients, 10 investment centers around the world. So we're a big player, we're a very well-known player, and again, well established, especially within the model portfolio business. As a firm, we're the third largest asset manager and the third largest ETF provider, but we're also in the top 10 for ETF portfolio model manager. So that's important because we do have a track record here and can share that track record with you to give you an idea to share with your clients overall. But with the entire $3 trillion, this is how essentially it's broken out between the different business models and business segments. Almost a little over $800 billion in intermediary. This would include our ETF business overall. We have a little over $500 billion in defined contribution, and we do manage money for some of the largest institutions in the world. So nearly $500 billion within that category as well. Let's talk a little bit about the team managing the model portfolios themselves and a little bit of State Street. As mentioned, we are 225 years old, the third largest asset manager and the #1 sovereign wealth manager in the world. We created the very first ETF in 1993. That's SPY, or S&P 500 ETF. That is nearly a $300 billion ETF. It's the largest ETF in the world. So not only was it the first, but it was the largest, and it is the largest. And transactions a day on that ETF are well over 20 billion per day. So that ETF trades over 20 billion a day. So not only was it the first, but it's the largest, and it's the most traded, so most liquid in the world. So we have nearly 800 billion in global ETF assets. In our investment solutions group, that's the team that will be managing these model portfolios. They are a global team. So there's 8 investment centers around the world. Each member is about 15 years in investment experience. And again, from a portfolio model experience, they manage a little over 200 billion. So I talked about the age. I've been at State Street for over 20 years. I can tell you it's a very client-centric organization. Clients absolutely come first, and I've been in a few different areas, and I can tell you it's no different regardless of the area. So I think you can take solace in knowing that we care about you and you're first on our mind before anything else, and that stands true. Again, I've been here for a while. I'm a little bit one of the senior members here, but I can tell you that very client-centric, and it's a great place to invest, or a great team to invest with. So why models? You know, we've talked about different activities in terms of developing models and trading portfolios, but the time required to do that and some of the opportunity costs. Some of our biggest clients from our ETF business use model portfolios because they want to spend more time with their clients and understand that engaging with them and the holistic approach is much more important than the day-to-day nuances of trying to pick the best investments overall. So some of our biggest, most successful clients within the ETF landscape are really those that outsource their their investment strategies to model portfolios and to State Street to do that. And again, it's because they're looking to grow assets, they're looking to spend more time with their clients, and that's truly what clients, how they benefit and how they see you as necessary. It's the time you spend with them that's critically important overall. So what are our capabilities? Well, the strategic allocations that we're going to talk about today, the 6 risk-based models, there is an annual evaluation, and that evaluation, it deals with changing the asset allocation itself. So whether we are increasing or decreasing our equity allocation, we can, this is where we would include new ETFs. In the past year, we've included corporate, short-term corporate bonds. In the previous year, we started to include emerging market bonds, and we will do that once a year. So we will add or we can take away ETFs as such. The benefit to that is there's low turnover. So in terms of turnover, generally leads to much more tax-efficient portfolios. So that would be, if these are tax sensitive for your clients, these would be good allocations to have. Again, a monthly evaluation overall, but we can make many changes, again, within that single annual rebalance. We can simply rebalance the original allocation, or we can change that allocation, start to include new asset classes. As mentioned, last year was short-term corporate bonds that we included. The previous year was emerging market bonds overall. And that's important because, especially this year, as coming up into election, that can change dramatically the investment landscape that we're used to. So a quick look at the Investment Solutions Group. I'll use the acronym ISG to refer to this team. So over 45 investment strategists dedicated. There's no B team here at State Street. This team is the team that runs these models. You'll see at other firms, they might have a B team that manages model ETF portfolios, but it's the same team that manages the model portfolios, that manages investment decisions for some of the largest investment companies in the world. Very experienced, over 16 years of investment experience. And again, we are a global firm, so we have investment centers in London, Tokyo, Sydney, Hong Kong, Montreal, etc. So it spans the globe, and the investment strategists also span the globe. So we get a very unique, comprehensive global perspective when building and reallocating these model portfolios. This is just a quick look at the Investment Solutions Group, where people are located. Again, very global in nature and extremely collaborative. They meet at a minimum of once a month to talk about the investment landscape, but certain inflection points that might happen, the election being one of them, they will meet more often than that to share ideas. This is a breakout of what the Investment Solutions Group looks like in terms of profile. We manage about $31 billion in tactical. Exposure management is about $25 billion, but our strategic asset allocation, that's really the bulk of where we manage our assets, and that would translate to these model portfolios. So about $140 billion overall in strategic asset allocation. So again, over 40 years of institutional asset allocation experience, that's how long we've been managing model portfolios, a multidimensional team and organization. We used a balanced approach, meaning we use both qualitative and quantitative inputs into building the models for you, and some of that forms the best thinking for our tactical models as well. So how do we start? Well, with the actual model portfolio process, we start with the asset class opportunity set. So that would include U.S. equities, international equities, emerging markets. On the fixed income side, it can include high yield, corporate debt, U.S. treasuries, U.S. agency mortgage-backed securities, mid and small cap, etc. We basically have an asset class forecast that we look at to decide on the asset allocation, but we also consider the risks of each of those asset classes when creating our model optimization. From there, we have a fundamental review, and we have the fourth step is the portfolio implementation. That's actually coming up with the the full model itself and delivering it to the client. One thing you might be interested in, and this is something that we do provide for those that do use our models, it's our long-term asset class forecasts. We come out with these on a quarterly basis, and here there's multiple, there's dozens of asset classes, but this is how we break them out into U.S. equity, large, mid, and small. On the international side, global and ex-U.S., we also break them out into the regions. We also have advanced beta, or many of you will understand the term smart beta. So minimum variance, that's low volatility, quality, momentum, value. We give forecasts for those factors as well, and for alternatives. And to the right, you'll see our bond forecast as well. So for example, our U.S. equity forward-looking one-year return assumption on U.S. large caps is about 6.3%. On small caps, it's about 4.7%. Again, we utilize these asset class forecasts to form the basis and the foundation of the model portfolios that we create for you. The portfolio construction, again, 6 model portfolios, roughly. They span from conservative to maximum growth. We'll get into a little bit more detail on these, but the conservative, it's roughly about 20% in equities, all the way to maximum, where we have nearly 98% in equities, about 2% in growth in fixed income overall. But this is the benefit, is really, understanding your clients and the risk return tolerances that they can handle would decide on what basically portfolio to choose, whether from conservative all the way up to maximum growth. Again, the qualitative review, this validates the strategic allocation within the 6 risk-based portfolios. The portfolio management team reviews the asset class mix for reasonability. And this is very important, given the change this year in terms of a potential market regime change within Washington, D.C. And that is important because they all have different taxation and different things they're looking at, and those all could affect the market going forward. So we're reviewing these considerations. We look at, again, expected return and risk levels, liquidity constrictions within each of the asset classes, drivers of return. As mentioned, there's a potential for a new regime in Washington. That could be a new tax regime, new economic policy, and that's important as we come up on the rebalance that's coming in January. Okay. I want to jump ahead to the actual portfolios themselves. So these are the portfolios and the makeup of those portfolios. So again, from conservative, which is a 20/80 allocation, all the way up to maximum growth, which is a 98/2 allocation. What's different for these is that there's really very little overlap. I think this is one of the benefits to using model portfolios that a lot of individual managers don't completely understand. We're utilizing ETFs that have very little, if any, overlap. So we're not doubling down on certain areas of the marketplace overall. We do use, from our U.S. equity sleeve, we do use the S&P series. This has been very beneficial, and I'll explain why. So the S&P series, for the S&P 500, that's the large cap segment, the mid cap 400, that's the mid cap segment, and the 600, the small cap segment, they are all mutually exclusive, so they don't have any overlap between them. The other benefit is, to get into any one of these indices, a company has to have 12 quarters of positive earnings. That's a big benefit in this type of environment, especially in the first quarter, because if you have a company that has negative earnings, it can basically go from the S&P 400 or mid cap down to the 600. We wouldn't include that in these indices because they would have negative earnings. So you're not getting these fallen angels that potentially continue to fall. You actually have a very high quality index that only includes companies to get into the index that have positive earnings. And that's a big differentiator over long periods of time. And I think you'll like that within that series. We break out international between developed and emerging markets. So developed would contain Europe, Japan, Australia, emerging markets, China, Taiwan, Brazil, etc. And we have a balance of that across the different risk spectrums. We also include international small cap, which is unique for a lot of model portfolios. For many international ETFs, they don't include small cap. And so it's an important consideration to actually use them within the model themselves. So they are actually two separate allocations that we have. We have international small cap that we include all the way up to 4% for our maximum growth and 2% for the emerging markets small cap. I find it to be very beneficial because most of these small cap companies derive their revenue from local sources. So even if we have a lot of tariff talk, et cetera, it won't impact those companies as much because they derive a lot of their revenues simply from local sources, and that holds true for U.S. small cap companies as well. On the fixed income side, again, very well diversified. We start with the aggregate bond index as the major index for our conservative and moderately conservative approaches. The aggregate bond ETF is basically U.S. dollar-denominated investment-grade bonds. So it contains U.S. treasuries, U.S. agencies, and investment-grade corporates. We also include TIPS, which are not included in the aggregate bond ETF. So TIPS are a great inflation hedge overall, and we include high yield. So again, those are two areas of the fixed income marketplace that aren't in the aggregate bond index or aggregate bond ETF. A lot of folks won't realize that, but this is the benefit to using the model portfolio. So we include those within this allocation as well as emerging markets. And then we refine every year using the last four. So that would be our intermediate term corporate treasuries and long-term treasuries. We use these allocations to refine the fixed income portfolio to either add yield, add duration, or remove duration from the portfolio as we see fit. Lastly, we include our real asset sleeve, which is our global real estate allocation. So this would include not only REITs from the United States, but global real estate companies outside the United States. It does include emerging market countries as well, and we have an allocation to cash within this framework. So roughly 2% for all of these. So if we turn, we do have performance as well, and we have the benchmarks that we use. We're happy to send you these as we see fit. But I wanted to stop there. I know we're coming up on about a half an hour. I'm happy to answer any questions that you have on State Street, on ETFs in general, or on our model portfolios. Bobby and I are happy to answer those questions. So just fire away if you do.
And then I'll just add, Mike,
any questions yet in the chat box?
I'll just add a little color on materials that we have available for you all. So I think you probably received hard copies of these, but we do have a marketing brochure that's client friendly. It'll talk about what model portfolios are, why you might consider using model portfolios. It'll give a little background on the investment solutions group, which is the team that runs these, as Mike talked about, and then get into kind of that efficient frontier in terms of the different risk tolerances. We produce our fact sheets on a quarterly basis. Those will go through all of the different asset allocations for every risk bucket, as well as performance, similar to what you're looking at on the screen right now. And then we also produce quarterly commentary. So that'll be available to give you guys a little bit more color on what the team is seeing in the current landscape, in the market, and kind of why they're positioning the portfolios the way that they are. So we're going to make sure and provide those to you guys on a timely basis. I'll send our most recent versions of all of those in an email following the presentation here. And then if there's questions on any of that stuff, please reach out.
We have one question from Walter, and it's how much was the model portfolio down at the bottom of the year? So basically, I'm assuming the question is what was the drawdown of the moderate portfolio, and that's something I'll dig up for you. I can tell you just from a pure U.S. equity perspective, the drawdown in the S&P 500 was about 30%. Treasuries were actually positive during that time period, so somewhere between those two. But let me dig that number up in terms of max drawdown within that period, and I'll get back to you, Walter, on that. Any other questions we can answer for someone? If you're shy, don't hesitate to reach out to myself or Bobby, and we can answer those questions at a later time.
Looks like there's one more question there in terms of.
Yep, I got it. Do you give advisors permission, ability to use provided literature in mass client emails? I believe they are publicly approved. So so that
all of our model. Yeah, all of our model materials are available for end client use. So yeah, feel free to use that stuff. One thing we didn't touch on either is the expense ratio of the portfolios. You know, one of the big benefits that Mike mentioned early in the call is that these are extremely tax efficient. The turnover on the models is relatively low, and that's by design. These are meant to be strategic, you know, long term in nature. But the underlying ETFs that we use are all really low cost as well. So the average weighted expense ratio for all of these models is 10 basis points or lower. So you'd be hard pressed, I think, to find lower cost models out there. So from that standpoint, these are pretty competitive strategic model portfolios. Any other questions out there? As I mentioned, I'm happy to jump on any follow-up calls. I know is willing to jump on those as well. So if you guys want to get a refresh on the story or the models or have questions that do come up, you know, we'd be happy to be a resource for you. One more question for you, Mike. They're asking, do they have capital gain distributions?
Do they have capital gains distributions? So historically, there are cap gains within ETFs are very, very small. I don't believe we had any capital gains distributions within any of our ETFs last year. So from an individual ETF perspective, there were none last year. We should have our cap gain estimates coming out in the next couple weeks overall. Another one, do you have risk tolerance tests for clients? I'm not sure what that asking. That's from Jamie.
I don't think that's something we provide.
Yeah, risk tolerance questionnaire. I know a couple different managers or end users that we utilize have their own risk tolerance questionnaire to go through questions with clients to see what type of portfolio might line up with them.
I do not believe we do have that. I will double check on that end to see if we do.
Yeah, and then in terms of that question that we just jumped over, how often are the portfolios rebalanced? These are strategic, so the team is going to look at these once a year in terms of how often they're going to be reallocating the portfolios in terms of shifting towards large cap or shifting towards US and you know, some of those types of changes. In terms of just rebalancing to those strategic weights, I think that's actually something that's actually more up to you guys and probably Andy and your team. You know, we do have clients that like to rebalance quarterly, some like to do it semi-annual and some annual. So in terms of just rebalancing to the portfolio weights, you know, that's kind of at your guys' discretion. But
and typically, what time of year do you guys look at the portfolios for adjusting them? Is it towards year end, correct?
It is. It's January of each calendar year.
Okay.
Were there any changes due to turbulent markets? So no, because these are strategic allocations, we will stay the course. And I can tell you, trying to trade the volatility is extremely difficult to do, trying to get in and out of the market. It was very much a benefit that we have an annual rebalance on these, because the decline in the rebound that we had in the first quarter was pretty much the sharpest decline and the quickest rebound we've ever had. Time to time that, I can tell you, if you look at tactical managers, very, very difficult to do. And my guess is the majority of them trail the market. So we do not, again, the annual rebalances, these are strategic. We're going to hold steady to the asset allocation for the year and change that allocation as we see fit, only once a year in January.
So maybe you guys touched on this already and I missed it, but you know, these specific strategic asset allocation models, how long have they been out there? What kind of, how far back can you point them to? And then the individual funds inside of there, maybe they go back even farther in terms of performance as well.
Yeah, the individual ETFs themselves go back, almost all of them go back more than a decade or close to a decade. So plenty of that. But the overall strategics have about 3 years of track record. And we can provide a breakdown. It's here on page 32 that I'm showing. But if you'd like to see something more granular, like a quarter to quarter, just let us know. We're happy to run that. But it's roughly a 3-year track record.
And then one of the reasons,
and also,
you know, well, I was just going to add to that quick. You know, the 3-year track record, that actually coincides with a rollout that we did with TD Ameritrade about 3 years ago, when they created a commission-free platform, and that's back when not all ETFs were commission-free. And so these portfolios were designed with that in mind, and so that kind of started a fresh track record that we've carried forward with the TD Model Market Center and these strategic portfolios. But if you look at the ISG team and how long they've been manning, you know, strategic asset allocation portfolios, that actually goes back to the early 80s. The team has a very long track record, decades long, of running asset allocation strategies, you know, very similar to what we're doing here.
Also, a question I've had and been asked, in terms of the updates in January, how much portfolio turnover would you say you have? I mean, every year is going to be different, but on average, what would you say you're looking at? Is it more in terms of percentages for each individual holding, or is it really moving in and out of specific ETF portfolios and funds?
Yeah, I would say the range would be in the 0 to 20% allocation turnover range overall. In many cases, it's just rebalancing back to the strategic weight. But the inclusion of an ETF, that won't add a tremendous amount. For example, our short duration was less than a 5% allocation. So I would say in a model year, 0 to 20% is average turnover. And when in January would U.S. advisors get the new allocation? I believe we rebalance by the end of the month. We do have some discretion on when that happens, but it is by the end of January that you would receive the new allocation.
Any other questions that we have out here? Obviously, this won't be your only chance to ask questions on these specific model portfolios, whether it's with us directly at US Advisors or specifically with Mike or Bobby. But please feel free to ask any more questions. Type them in there. Anything else, Bobby and Mike? Anything else you guys wanted to touch base on or wanted to make sure everybody here was aware of?
Yeah, I would say don't hesitate to reach out to us. Where if you just wanted to talk one-on-one to get a little bit more granular on the portfolios overall, please give us a call. We're happy to talk at any time.
And for that, would you say the best protocol is to reach out to Bobby? Say if somebody wanted to talk to you specifically, Mike, would the best route be to go talk to Bobby and get that set up through him?
Yes, he has the bat phone number, so absolutely.
Yeah, reach out to me. I'll send an email
Very
to the
good.
group following this with some PDFs of all of our materials. You'll have my contact info that way. And yeah, as Mike mentioned, don't hesitate to reach out. We're happy to be a resource and look forward to working with all of you.
Great. Well, with that, I mean, I think we covered it in an efficient manner. Gives everyone a little extra time here today. We're very excited for the partnership with State Street. I know we've been looking at different opportunities, different model portfolios that we could utilize, and this really hit the nail on the head as one of those options. So, as you guys talked about, low cost, efficient, time tested, stuff that we're really looking for from an advisor client perspective. So we appreciate that. We're looking forward to it. And we'll follow up. Bobby's going to send out an email. We'll have an email as well, similar, and then we'll have updated IMAs and all that stuff for you all here today. So be on the lookout, but don't hesitate to reach out with any questions, and we'll continue on from there.
Thanks, everyone. Have a great weekend.
All right. Thanks for the time, everyone.